Thanks for tuning in to Within the Frame. I'm Handan in Seoul. Interest rate settings by the central banks of advanced economies are making headlines this week. The U.S. Federal Reserve has left interest rates unchanged, saying inflation has eased over the past year, but remains elevated. Just a day before the Fed's announcement, the Bank of Japan raised interest rates for the first time in 17 years. All this as South Korea struggles to tame inflation amid soaring prices of fresh produce and energy. To help us break down the numbers, we have Song Soo-young, professor at Chung-Ang University's College of Business and Economics, joining us tonight. Thank you so much for joining us.
Thank you for inviting me.
Also accompanying us tonight is Greg Buchak, professor of finance at Stanford Graduate School of Business. Welcome to the program.
Thanks for having me.
Let's start with you, Professor Song. The U.S. Fed froze its key interest rate as widely expected, but what investors were waiting for was the dot plot, a chart that predicts the direction of the Fed's rates. Could you give us your analysis of the dot plot and help us understand what we can expect down the road this year?
Yeah, among the members who participate in the FOMC, and they make an individual forecast about what would be upcoming interest rate level for the federal funds rate. So according to the dot plot, it shows that majority of the members has predicted that 4.5% and the 4.75% range would be most likely to be the year-end short-term interest rate. So that implies that we expect 3 times 25 basis point decrease of the federal funds rate for the following months. So this implies that actually at least the Wall Street and the other stock market responded positively. The reason is because at least the Federal Reserve System is stick to what they make a forecast in the last year. So that is good news to the stock market because there is no chance of increased interest rate. Therefore, surely the increased interest rate will be decreased over time. Then also another. I don't think this should be a really good news, but the unemployment rate is a little bit increased. So that is also the possibility of increased short-term rate is not plausible. So to that regard, that's why we have seen some positive response in the stock market.
Markets were predicting more of a hawkish stance from the U.S. Fed after the key gauges of U.S. inflation, like the consumer price index and the producer price index, both came in hot last month. But the U.S. Fed today indicated 3 rate cuts this year. 25 basis points each is what we're expecting. Professor Buchak, another watch point of this month's monetary policy meeting was whether the U.S. Fed will revise its economic outlook for this year. As anticipated, it revised up the real GDP growth outlook to 2.1% from its previous forecast of 1.4%. What's behind the adjustment?
Right. So as you said, they upgraded the forecast from about 1.4 to 2.1% growth. They have a similar revision also for 2025. And by the way, this is consistent with a very slightly more hawkish dot plot that we saw. So they're still predicting the same number of rate decreases, but sort of the path of that is a little more hawkish. Let me give you a few other numbers in this prediction, and then I'll put it in some context. So the Fed is also forecasting continued unemployment of around 4%. And they're also forecasting inflation of around 2.4% this year, which is going to fall more over the longer run. So over the longer run, what the Fed does is sort of target this 2% inflation number and around 4% unemployment. Kind of thinking about where we are right now, that means unemployment is pretty good. Inflation is still slightly high. And these conditions kind of in the calculus of the Fed sort of call for modestly elevated rates with perhaps some decreases into the future. And that's kind of what we see in the dot plot. But we're definitely not in a position that's calling for dramatic action one way or another. So how did we get where we are? So as you recall, inflation was very high in 2022, 2023. The Fed raised rates then to cool off the economy. Now, typically the thinking is that higher rates kind of lower inflation, but they may reduce growth and increase unemployment. In response to the Fed's rate hikes, inflation did fall dramatically. It didn't quite get all the way there. But more surprisingly to the Fed, economic growth and labor markets remained pretty robust. So they didn't slow down as much as a lot of people at the Fed thought. What are a few big drivers of this? So the US actually did a ton of COVID stimulus. That's actually still working its way through the system a little bit. A big surprise in the US has been a surge in labor productivity. So that's kind of amount of output per hours worked. That's surged since COVID. And then finally, the US has just had a bunch of good economic shocks. So natural resource discoveries, technological breakthroughs, and so on. And this is all kind of combined to give an economic glide path that's been a little bit stronger than what the Fed was thinking and leading them to revise these growth forecasts upwards.
So what was behind this growth outlook is the U.S. economy that has stayed resilient throughout the COVID period as well. And the unemployment number, it's in the 4% range, inflation in the 2% range, which is both modest. Inflation still a little bit hot. But so you are saying that the growth outlook is looking a bit positive.
Definitely more positive than what the Fed was anticipating when they started the cycle.
All right. Now, Dr. Song, how do you assess the Fed announcement's short-term and long-term impact on South Korean markets?
Actually, there is no such a direct impact on the Korean market, but at least the financial investors from US, they would like to come to Korean market to make an investment because particularly Korean market, stock market is market price of stocks is very close to the book value of the assets of the company's assets. Therefore, the PBR is very relatively low, and therefore they would like to take advantage of this situation. And on the other hand, then as Professor Buchak has mentioned, that our prospect and resilient growth rate of U.S. economy is quite good, and then the issue is whether the United States would like to extend or increase the import from abroad. That is the question, because clearly the Biden administration, the U.S. government is very worried of some kind of import from abroad, particularly from China, and that means that could help the domestic economy for the U.S. to maintain the current level of growth rate, economic growth rate. That is very good. But for South Korea, whether it to be good for South Korea, that it should be the United States. I would like to encourage the U.S. import to South Korean products further, because South Korea has been some kind of the bumpy relationship with China. So because China was the largest trading partner of South Korea. So that's why the U.S., I encourage them to purchase more imports from Korea.
You heard that right, Dr. Buchak. Yeah. More imports from Korea, please. Now, Professor Song, how would it impact the Bank of Korea's future interest rate settings?
I guess it's very similar to the Fed, because Fed, Jerome Powell has mentioned that there is some two-sided risk, whether to the interest rate could have a negative impact on leading to the recess in the economy. That is good, but that is but definitely bad news. On the other hand, if the inflation comes back and then it goes up, so that's why they stay what they are right now. For South Korea, the bank rate, I think a little bit differently, because even though our price inflation rate is 3.7%, and as you mentioned, the anchor mentioned earlier, the fruit price has been increased dramatically so much in South Korea. But still, we need. So inflation should not be a primary concern and worry about the South Korean economy. currently the growth rate of GDP growth rate is really not good. So that's why I encourage the Bank of Korea should decrease interest rate as soon as possible, considering Japan has maintained a negative interest rate for almost 17 years. For the first time, they increased just 0.1 percentage points and reached a 0-point interest rate. So then they have enjoyed not only the increased inflation, but also with increased growth rate of GDP. So we, South Korean government and Bank of Korea should take into think of the prospect of the economy from Japan.
The Bank of Korea has always faced the big dilemma of between inflation and growth, but now you're saying that it's time for the BOK to focus more on GDP growth.
Right.
Professor Buchak, meanwhile, the Bank of Japan has raised interest rates for the first time in 17 years, putting an end to the country's negative interest rate era. The central bank projected that the price stability target of 2% would be achieved in a sustainable and stable manner. How do you gauge the impact of Japan's historic rate pivot on global financial markets?
Sure. So Professor Song mentioned this too. Japanese rates went from negative, very low, to let's call it slightly less low. So it wasn't a huge move, but it was very notable. It's the first time they've done this in a long time. The market reaction was actually sort of muted. It kind of tells us people were a bit anticipating this, and maybe the impact on the real economy, at least from this small rate increase, will be a bit modest. I think kind of the more interesting question here is why rate increases in Japan have been so low and so rare relative to other countries. Kind of why is this a big deal? You know, we're coming in the broader context, we're coming off of the so-called lost decade in Japan. It started in the 90s. It's gone on for way more than one decade. Kind of background here, there was a big asset bubble in Japan in the early 90s. Japanese private sector became very indebted and they became underwater as the bubble deflated. What happened in Japan is all the firms responded basically by paying down debts rather than investing. Okay, and this kind of led to this vicious cycle where everyone's paying down debts, they're not investing, that slows down the economy, that makes future investment even less profitable and so on. And so they do less and less of it. This generated this sort of so-called lost decade dynamic. By the way, there's a lot of concern now that that's where the Chinese economy might go as their real estate bubble deflates a bit. But sort of the characteristic of this lost decade was very low price appreciation, very anemic economic growth. And during this, the Japanese central bank had a policy of low and often negative interest rates. They're sort of trying to pull the economy out of this slump, but there was just no demand to borrow, really. It's sort of like you're pushing on a string. You're not going to make any progress doing that. But, you know, back to present day, multi-decade long lost decade, Japanese companies are finally starting to borrow and invest again. Prices are starting to increase. So over the past couple of years, there have been some very sort of smallish price increases relative to the rest of the world, but large relative to Japan's history. So this sort of uptick in the Japanese rate of inflation has been significant and it's been very newsworthy. I think the other side of the story here is, as Professor Song mentioned, is economic growth. Okay, so economic growth in Japan is positive. It's not super robust. I think the latest real GDP growth is around the 1.25% range. That means the central bank needs to be very cautious here about raising rates too aggressively. They don't want to sort of prolong their lost decade into another a decade.
Analysts are also talking about the possible repatriation of huge capital back to Japan because investors have been using the so-called yen carry trade to borrow money from Japan, taking advantage of low interest rates and then investing in foreign currency assets. So I guess we'll have to also keep close tabs on how that will impact global markets. Professor Song, some analysts predict Japan's rate shift will bring positive effects to South Korea's stock markets as well as exports on the back of strong Japanese yen. What's your take?
So as you just explained, the yen carry investment could be very attractive because they expect appreciation of the Japanese yen currency against the other US dollar or whatever it is. So it means because of the increased interest rate, then people would like to think, particularly some financial investors would like to think of the appreciation of the Japanese currency. That's why they would like to focus on yen carry, as well as then from South Korea perspective, the export to Japan market would be a little bit favorable. But as the Professor Buchak has mentioned earlier, actually, the chairman of the Bank of Japan, Gazuo, Ueda Gazuo, has been very cautious about it. The reason why he increased the interest rate from negative to the 0% rate is because waiting for another several months is maybe they lose opportunity. So they are very cautious about that could have a negative impact of the recovered economic growth rate, the GDP growth rate. So Japan has recorded a 1.4%, even though it is very small, but considering the past lost decade of the period, the Japanese GDP growth rate always very close to zero. So that means 1.4% is really huge in that regard. As a result, the Kazuo is very cautiously, and then he says he is not going to increase the interest any further. And also, he must be worry about some too much appreciation of the Japanese currency. That could have a negative impact of Japanese GDP growth rate. So to that regard, Japan would be very cautiously and stay where it is right now at 0%. So it doesn't have a much positive impact for Korean export to Japan. I don't think so. So then we need to, South Korean government, what we need to do is our domestic economy should be of the focus of interest.
So the impact on Korean markets and exports will be limited. And staying with you, Dr. Song, let's talk a little bit about the continuing fruitflation in Korea. The soaring prices of fresh fruits have prompted the government to rein in to stabilize prices. What's your perspective on the current state of fruitflation and its impact?
Actually, I didn't think of much about the fruitflation, and I heard this word for the first time. And I looked into some data. And I found in 2017, among the OECD and the developed countries, the price of a fruit index, the highest country in the world, actually, is Antigua and Barbados, which is some island country in Caribbean Sea. So you have no idea. But among the advanced countries, Japan is ranked 6th. South Korea is ranked 7th. So that means fruit price index has been quite high in Japan and South Korea. I don't know exactly why, but maybe because of the size of the terrain or space to be used for the cultivation of fruit may be very expensive in both countries. In the year of 2023, the apple and pear takes the huge amount of source of revenue, and there are some data about the source of revenue and bananas and other types, several types of fruits. Most of them is not grown in South Korea. All we have is apple and pear, and also this kind of fruit has the feature of the products is really monopolistic competition. Why? Because even for the same apple, the taste is quite different from in South Korea, the South Korean apple and the North American apple. And considering the difference between of the North American style pear and the South Korean pear is totally differently tasted fruit. Therefore, they have some monopolistic competitive power over the market. And that means it is quite subject to the supply constraint or supply change. And also in Korea, South Korea, the auction market that was conducted for the purchase of the fruits and the dispersed distribution among some end users or end consumers of fruit is quite the difference is quite big. So that means there is a price gouging is possible for the auctioneers. So intermediary retailers or wholesalers, they take most of the some value added profit, not value added, it's just a profit out of the from the production of fruit. So that's why we need some kind of price control maybe needed for fruitflation, against the fruitflation.
All right, because we are a little pressed on time, just very quickly before we let you go, Professor Buchak, how much longer do you expect global oil prices to lead inflation?
Yeah, so kind of like the broader context here is global oil prices are high over the last 4 months or so, but they're kind of low relative to where they were earlier in this inflation spell. So things have come down a lot, things have normalized a lot. Oil is one of those things where it's super, its price moves a lot at the whims of big oil producers around the world. So think of like OPEC or Russia restricting output. That's going to have a big impact on prices. That kind of price manipulation is becoming harder and harder all the time, though. First of all, oil production outside of these big production blocks has been rising. So for example, the US is producing more oil per day than any country in history around now. So that this kind of undermines the ability of Russia or OPEC to kind of manipulate prices. And then on the demand side, there's been this rise of substitute energy sources. So the one that probably comes to mind is green energy, but also things like the rise of natural gas. This has really changed the demand dynamics around oil. So this kind of has the effect of blunting demand for oil, pushing prices down a bit. I don't think that oil or energy prices are going to be a huge component in global inflation. At least in the US, energy prices are not really driving where we are in terms of inflation. It's much more housing costs and services.
All right, there you have it. Thank you so much, Professor Song and Professor Buchak, for your valuable insights tonight.
Thank you.
And that brings us to the end of this show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.